Hi, I'm Ken Bauso. I'm the Chief Investment Officer of Maridea Wealth Advisors. I'm also an investment advisor myself. And this is an economic and market overview, part one. Part two, I'm going to talk about 2025 significant policy questions and implications, but I am going to touch on a few of those right now because I'm recording this on Sunday, February 2nd. So we have had Trump announce tariffs that have gone into effect this weekend. It's a 25% on Mexico, 25% on Canada, 10% on China. And just to speak to a few, I think, misconceptions that are out there in the press. The first thing I would say is Wall Street was definitely concerned that Trump may make some aggressive tariff decisions, meaning that the rates would be high and they would be very broad and they would come in quickly. On the other side of it, there was some thinking that the tariffs would be a threat and ultimately they would come in at a more measured pace. So what we've seen is certainly closer to the former. We've got broad, pretty wide sweeping tariffs, and it's happened pretty quickly. So I think that is going to be a concern. But what I really want to talk about is whether the tariffs are likely to be inflationary or not. In 2018, Trump put tariffs into place, and we saw that there was a mild amount of inflation that was really a one-off inflation. And I think the analysis here looks like this, basically. When Trump was elected in November, in the fall, the market reaction had the dollar scream higher. So the first important point about tariffs is to talk a little bit about the currency. If the dollar goes up 25% against the Mexican peso, then the good that you purchased for $100 in the fall would have gone down in price. And if that good now has a 25% tariff on it, that price would be the same as it was in the fall. So the currency moves do matter. Now, I just used 225% in that little example, but we have had quite a strong move in the dollar. I think we will see the dollar strengthen even more because this is a little bit more aggressive than I think Wall Street was hoping for. And so the point I want to make on the first point I'd like to make on the tariffs is that the currency movements will serve to offset a significant part of them. That's number one. The second part of it is the thinking behind having a more measured and targeted tariffs is that if there are industries where there are US producers in that industry and there are overseas producers, let's say you go to the store and you want to buy a shovel, and there are American-made shovels and you can buy one for $20, and there are shovels that are made in Mexico and you could buy one for $18. So you decide, I'm going to buy the one made in Mexico for $18. After the tariffs, then the American-made shovel has not changed in price. So you could change your buying behavior. Consumers can change their buying behavior and buy the made in American shovel at the same price as it was before. So that does serve to offset some of the effect. Now, of course, that would require that we're talking about goods that are made in the US and also made overseas as a competitor. Now, in that little example with the shovel that I just mentioned, imagine that's the case and you are the producer in Mexico or somewhere in that chain of your producer or importer or seller, and your product used to cost $18, but now with the tariff it would cost something more than $20. You may be likely to reduce your margin in order to make your price competitive with the US-made shovel. And in that case, that also means that to the consumer in the US, the price rise will be less than the total tariff. So between the currency movement of the strong dollar, between the ability for consumers to switch, and for the producer to eat some of the tariff, I suspect that what we will see is a mild one-off price rise and not an inflation spiral. If you smoke cigarettes and they put a tax on your cigarettes, then what happens is your disposable income to spend elsewhere goes down. There's no new money created in that process. So this is, I don't expect there to be some kind of inflation spiral, and I'll have more to say on this in part 2. To start with the market and economic update, I want to take a step back, and first let's look at the components of the leading economic indicators. This is an index that's put together by the Conference Board, and the reason I want to start with this is there are so many variables in the economic world, and therefore when the Federal Reserve speaks about what's important to him, the chairman of the Fed speaks about what's important to him, he can craft a narrative using such a wide variety of variables. And it's worth it to look closely at what he's pointing to and what the other members of the board are pointing to, because they're very powerful. But it's also important to understand how the economy works, broadly speaking, too. And so let's start off just looking at the leading economic index. And as I said, the Conference Board puts this together. This has been poured over by PhD economists and statistically really put through the ringer. And these components have been shown to lead the economic cycle. And rather than looking at the particular readings from this cycle, let's really just look at the components. The top 3 you'll see there are financial components, leading credit index. You'll see the stock market. They consider a leading indicator, and I'm going to talk about that a little bit more later. You'll also see the interest rate spread. This is a yield curve spread, 10-year minus Fed funds. And then there's a handful of other non-financial components. Importantly, I want to point out what is not a leading indicator. Inflation is not on this list. Inflation is a lagging indicator. The inflation we're seeing now is a product of the economic and monetary conditions 12 or 18 months ago. Also, there are some employment-related metrics, for example, hours worked, and typically first hours are cut, then hiring is cut, and then people get cut. But a lot of the employment-related indexes that they closely monitor are also not on this list. And if you think about this, it makes sense, because there's no real special insight into the 6 to 12-month future that businesses have, right? Businesses spend a lot of time and money to hire people, and they are very slow to let them go. And they typically only do once things have already gotten bad. Once things have already gotten bad and they really don't have a choice, that's the time we start to see layoffs. And so that is, if we think about the world as we know it, that's not a leading indicator. So how has this indicator done? If we just show this series, we can see that the Conference Board uses certain conditions to determine when there's a recession warning or when there's a recession signal. And so we can see why in the last year or two, many economists have been calling for a recession, because this leading economic index has been below that threshold level, although we have not yet had a recession. On the positive side, we can see that the leading economic index has increased in the fall for the first time in over 2 years. So this is a leading index, and it's turned up only very slightly, but that's positive. And from my research over the years with this data, I would like to point out that this index can be approximated with just one of the indicators, which is the yield curve. So we see when the yield curve, as measured here, 10-year compared to the 2-year, when that drops below 0, that has historically been an excellent indicator of a recession in the future. As we can see, there's been almost no times where it has dropped to 0 or below, and we haven't had a recession. Of course, we also see that we have been below 0. We're now just coming out of that, but we had a very lengthy period where the yield curve was inverted, and again, so far, we have not yet had a recession. So when I talk about when people say that monetary policy has long and variable lags, this is one of the major reasons. The dark green line is the current mortgage rates. The lighter line shows what the effective rate is that homeowners are paying. So even though the mortgage rates, as we all know, have gone up as interest rates have gone up, the lower line has only moved up very slowly. And we know why this is, because people have great mortgages. A lot of people who have great mortgages have decided to just hold on to them and not to move and be subject to higher mortgages unless they really have to. So sometimes people do have to move, and so we do see those higher rates slowly start to feed into that line. But this is why we have long and variable lags, because if companies have locked in low rates for a long period of time, if households have locked in low rates, then even if interest rates go up, it may not really have much of an effect on their life. However, over time, more and more, it will start to have more of an effect. Another good leading indicator is residential investment. Obviously, this is very related to interest rates. And so this is a white paper from the NBER that calls for residential investment offering by far the best early warning sign of an oncoming recession. So we can see median sales price of homes is also at levels that have mostly been related to a recession in the past. And I've put this slide up let's think about interest rates for a moment. And if you look at this slide, if you chose any particular interest rate, there are times in the past when it's been stimulative, and there are times when it's been contractionary. So we can't just look at one rate as being accommodative or restrictive. One thing that we can do is compare the current Fed funds rate to something else. And so there's a couple things that we could do. We could compare the Fed funds rate to inflation, okay, and that gives us what we call a real rate. And so if we look at the 3-month T-bill versus the core CPI, this blue line shows the real rate. And what we can see is that typically when real rates are high, that can also be an indicator of economic headwinds. And I think we've probably gotten a bit more sensitive to this as the economy has become more financialized and more leveraged over the last few decades. So that's one thing we can compare it to. The Fed funds rate to inflation. Another thing we can compare it to is what I was just showing you, which is the yield curve. So we can compare the short-term rates to the longer-term rates, and depending upon the spread between those two rates, that can provide a good indication rather than just looking at the absolute level of rates. This shows the Fed Summary of Economic Projections, SEP, and the reason why I'm showing this is because that part that's circled shows you what the Federal Reserve participants believe is the long-term neutral rate. And so the point is here that it's a very wide spread as to where neutral is. Neutral rate is not an observable rate, so the spread could be anywhere between 2 3/8 to 3 3/4 is what the participants think is neutral. Now that makes quite a big difference because Federal Reserve has rates that it's currently at 4 3/8. And so if the long-term neutral rate is 3 3/4, then they're only slightly restrictive. But if it's 2 3/8, then they're very restrictive. And so the point about this is the Federal Reserve, I wouldn't say they're flying blind, but they don't really know how restrictive they are. There's a peculiar relationship between what the Federal Reserve does with its interest rate moves and the movement of the 2-year government bond, which is not directly controlled by the Federal Reserve. And I think you would be forgiven to believe that what the Federal Reserve does is just follow the 2-year. And so this is a long term, this goes back to 1976, This is a long-term graph that shows recessions, the Fed funds rate, and the 2-year note yield. If we zoom in a little bit more, I think you can see that when the 2-year yield, that's the orange line, when it's above the blue line tends to raise to catch up. And so we've seen the same thing happen, and it was in September, as you can see, September of 2024, all the way on the right, where the divergence between the blue line and the orange line became quite great. And then you can see as those lines started to come together, that's when Powell has backed off and questioned, maybe we don't need as many rates in 2025. Currently, Wall Street is anticipating somewhere between 1 and 2 rate cuts in 2025. So I've just shown a bunch of indicators that would argue that we've got a bit of an elevated risk of recession. So why haven't we had a recession? Well, there's a few things that have happened. One is that the Federal Reserve has had this reverse repo facility. And this gets a little bit wonky, but what a reverse repo is basically the Federal Reserve borrowing money from the street. And so when the Federal Reserve does quantitative easing, they are buying assets with newly printed money. And so at the same time they did that, they can also borrow that money to essentially keep it out of the economy. And that's what they did. When you can see as this reverse repo line really ramped higher, that was happening at the same time the Federal Reserve was buying assets. As the Federal Reserve has been letting assets roll off its balance sheet, quantitative tightening, so to speak, this previously has been a headwind for financial assets. However, in this case, what they've also been doing is letting their reverse repo roll off, meaning that the money that they were borrowing, essentially taking out of the economy, they've been letting that roll off to put that money back into the economy. So they've really been offsetting each other, but as we can see now, they're getting down to pretty low levels in reverse repo. The other thing we have to talk about is the fiscal deficit. And we're running an estimated 7% deficit. And this, I think, really is a feature, regardless of whether we have Republican or Democratic administrations. A lot of this is baked in the cake that we will see higher deficits going forward. And so there's no question that the higher deficit was a benefit to keeping the economy out of the recession. Now, of course, Trump and Elon are working on reducing costs. Part of what's happening with tariffs is doing that also because tariffs raise revenue. So it's yet to be seen how successful they'll be at cutting spending. I wanted to look at the leading economic indicators because if we compare that to what Powell said in December, is they say they're going to be looking for further progress on inflation and the labor market. They are pointing to variables which are not leading indicators. And so if they are going to wait for inflation to get all the way down, we are going to run the risk that they'll go too far. Now, Powell has explicitly said that no, we don't need to wait to see inflation at 2% in order to become more accommodative. However, I think that the Fed is making a decision to err on the side of deflation or recession rather than too much inflation. I think the Fed's view is if inflation's too low, we know how to fix that problem, and we really don't want to get inflation anchored into the economy. What else could have kept us out of a recession? There's an important point here about the wealth effect and reflexivity. Alan Greenspan first started talking about the wealth effect in the 90s. And typically when we think about the stock market, we think of the market reflecting the value of the underlying businesses, or at least what the investors believe is a reflection of the value of the underlying businesses. Greenspan pointed out that, of course, this has some feedback mechanism, because if investors think that the value of these businesses has gone up and up, then that has a wealth effect, and the people who own those securities are more likely to spend money, and that spending of money helps the economy and helps those very businesses. George Soros has this idea of reflexivity where he talks about the interplay between the market price of an asset and how that feeds back into the value of that asset. And so part of the idea here is, let's imagine a stock like GameStop. Let's say GameStop is worth $15 a share, and the stock takes off and goes to $200 a share. Well, now GameStop can sell equity, raise a lot of cash. It can use those shares to purchase another company in acquisition. It can do a number of things that actually make the underlying company a lot more valuable than it was before. And so I think there's a significant amount of reflexivity going on in our stock market where, as you saw, the conference board considers the stock market a leading indicator. I'm inclined to think that it's less of a leading indicator and more of a coincident indicator, where when the stock market is strong and healthy, then the wealthiest people who have their wealth concentrated in stocks feel good, spend money, and keep the economy moving. And if the stock market goes on a downturn, then that is not just a reflection of the economy and the businesses doing poorly, but it feeds in to a much higher likelihood of the economy doing poorly. There's a bit of an odd relationship here between the 10-year index and the 10-year yield, the long-term government bonds. Doesn't have to be the 10-year, just about the market in general. And again, I know this sounds a little bit wonky, but I think this is a very important relationship. What we see if we look on a longer-term basis is that we can see back during the financial crisis, for example, and I know this was a flight to quality in 2008, but the orange line is the value of the dollar versus other currencies, the DXY index. The blue line are yields. So when that blue line goes down, that means yields are going down, which means the long-term bond prices are going up. So what we see in 2008 and 2009 is the orange line goes up, which is the value of dollars now went up, and at the same time, bond prices, which are just the promise of dollars in the future, also went up. So that seems sensible to me, that when dollars are going up today, it's inclined to make the value of dollars tomorrow going up. Also because we import more than we export, so when the dollar goes up, our goods become more expensive overseas. That's a headwind. People are less likely to buy goods as the price goes up. And as the dollar goes up, everything we import, we have the benefit of the price of that going down. So a strong dollar has a fundamental effect of being inclined to be deflationary. But if we zoom in on the last few years, so the next graph I'm going to show is just the last few years of this graph, then we will see that the relationship has become pretty close between the value of the dollar going up and the value of future dollars, which is all bonds are, going down. So this is, I think, an odd relationship. I think there are a few fundamental or technical reasons why this has been happening, and I think will likely continue to happen for a bit. Number one is that as the trade deficit goes down, typically, if we have a big trade deficit, those dollars are surplus to China or Japan. And typically what China and Japan do is they take those dollars and they buy treasury bonds. So if the dollar is stronger, or if we have tariffs, this is a great example, and we are buying less from the rest of the world, then they will have less dollars to buy our government debt. So I can understand that possibility. Another one is, as the dollar gets very strong, the Japanese yen goes down, right? Dollar up, Japanese yen down, and Japan imports a very significant amount of their energy. And so when the yen drops, they really feel it in their economy because their energy prices go up. And so Japan does not want to let the yen get too weak. And so they have intervened at times. I think they are likely at some point to intervene again. And when Japan's intervening, we think about what they're actually doing is they want the value of the yen to go up. Up against what? Up against the dollar. So when they're intervening, what they're doing mechanically is they are buying yen and they're selling dollars. And where are they getting these dollars from? They're getting them from their reserves, which are probably sitting in treasuries. And therefore, when the US dollar goes up, it makes it more likely Japan will intervene, which makes it more likely that they'll sell treasuries to raise dollars in order for the intervention. So that's another potential reason. I would also make the argument that if the federal government has promised too much, if we have too many financial obligations and the value of the dollar is going up, that is increasing the real cost of those obligations, which is bad for our credit profile. So while I think that's true, and while I think each one of these things that I mentioned has an argument in favor of why it's driving the markets as they are, I don't really know how big of an influence any of them really are, except for this narrative. But the dollar really took off when Trump was elected. The dollar got another boost in December when Powell laid out less rate cuts than the market had anticipated. As I sit here on Sunday, February 2nd, after Trump has announced tariffs, I suspect the tariff announcement will also be a continued tailwind for the dollar. All of these things will bring down prices and will be positive for inflation. However, at some point, to bring inflation down, the point of bringing inflation down, among other things, is to bring down interest rates. And so that may require a lower dollar if this relationship holds. This is a Shiller PE. This is a cyclically adjusted PE. It uses a cycle of earnings instead of just the past year. You can look at valuations in lots of different ways. This is only just one of them, but what it shows is that we're pretty expensive now compared to history. This is not a timing tool whatsoever. This is a very poor timing tool, in fact, and there's nothing to say here that stocks can't double next year, right? That's what I mean by a poor timing tool. This has really been a US phenomena where the US has really gotten more rich from a price earnings perspective than the rest of the world. To touch on Japan here, this is their yield, and so they are hiking rates while the rest of the world is cutting rates. And so this is one of the reasons why in early August of last year, we had some volatility out of Japan where the carry trade unwind. There are a lot of large players who borrow in yen at a very low rate and use those yen to buy higher yielding assets everywhere in the world. And so this is something that's important to keep an eye on for 2025. Incredibly, we're now seeing Chinese yields drop below Japanese yields. China is undergoing arguably a balance sheet recession. This is similar to what happened to Japan in the 90s. And essentially, I think it's driven by the weakness in Chinese real estate. And a balance sheet recession is really a dynamic that argues if an investor owns a lot of real estate and that real estate has gone down in value, then the People's Bank of China can cut interest rates. But the issue for that investor is not that interest rates are 6% versus 3%. They just become less sensitive to interest rates because the problem is that the investor's assets are underwater. And so even if rates go down, the economy is not that sensitive to demand more borrowing, and it requires a much greater effort from the federal government, which so far we have yet to see. And so that's why the value, the price of Chinese bonds has been screaming a lot higher, which is reflected here in the yields going lower and lower. Unemployment levels, household survey has typically been better than the establishment survey at turning points. And so even though levels are still very low, if you look at this blue line, historically, our unemployment rate is still historically very low. But this just compares it to the 36-month average. We can see that there has been some uptick. Still, it's very minor. However, this is what the Federal Reserve, I think, is looking at when they cut 50 basis points in September, and then they cut another 0.25% twice after that, total of 1% that the Federal Reserve has cut. What they are looking at is inflation is getting closer and closer to target. We're still not there yet. And the employment market, while still looking good, the rate of change is not quite enough to have them worried, but they're paying more attention to it. So stay tuned for part 2. Again, this is commentary and analysis and not investment advice. Please reach out to your investment advisor or your financial advisor to determine what is best for you.